Welcome back to Metal Market News. I'm Professor Harry, and as always, I'm here to give you an independent, no-nonsense breakdown of what's really happening inside the precious metals market. Today's discussion goes far beyond the usual surface-level narratives because what we're seeing right now is not just volatility, it's a structural imbalance forming beneath the market, one that most investors are either ignoring or simply failing to understand. We're going to unpack the contradiction between institutional forecasts and actual positioning, the growing divergence between East and West, and why this could lead to a violent repricing in gold and silver. And as an independent analyst, I'll not only walk you through the logic behind these developments but also compare it with my own view of where this market is truly headed, because in times like these, clarity matters more than ever. What we are witnessing right now is one of the most unusual setups in modern financial markets, where major institutions are openly projecting gold prices in the range of $5,500, $6,000, even $7,000, yet at the same time, they are not meaningfully positioned to benefit from that upside. This creates a deep contradiction, and as an analyst, I see this not as a coincidence but as a structural inefficiency in the system. Large asset managers, particularly those managing discretionary portfolios, are often constrained by benchmarks, risk models, and client expectations, which means they are slow to move into assets like gold despite recognizing their long-term value. Now, from a traditional perspective, one could argue that this is simply prudent risk management, because gold does not generate yield and can be volatile in the short term. However, when I compare this conservative positioning with the magnitude of their bullish forecasts, it becomes clear that there is a disconnect between belief and action. And in markets, these types of disconnects rarely persist indefinitely. My own view aligns with the idea that once these institutions are forced to reconcile their positioning with their forecasts, the move into gold will not be gradual, it will be aggressive and reactive, and that is when price acceleration becomes exponential rather than linear. Now, when we extend this analysis further, we begin to see the implications of what happens if institutional capital suddenly tries to enter a market that is already constrained in terms of supply. Gold is not like equities or bonds where supply can be expanded relatively quickly. It is a finite asset with slow production growth, and a large portion of existing supply is tightly held, particularly by central banks and long-term investors. So when analysts suggest that prices could rise sharply if institutions begin buying, I would go even further and say that the market may not be prepared for the scale of demand that could emerge. In my assessment, the real risk here is not just higher prices, but disorderly price discovery, where liquidity dries up and prices gap higher due to a lack of available sellers. This is what I refer to as a liquidity vacuum scenario, and historically, these types of moves tend to catch the majority of market participants off guard. While some analysts believe that markets will adjust smoothly, I disagree with that assumption because the structural positioning simply does not support a smooth transition. At the same time, we must consider the role of futures markets and the ongoing pressure within those systems. The idea that participants are being cleaned out of the futures market reflects the stress that leveraged positions can face during periods of volatility. Futures markets, particularly in London and New York, play a significant role in price discovery, but they are also heavily influenced by leverage and short-term trading dynamics. From my perspective, this creates a distortion between paper pricing and physical reality. While liquidity in gold may appear stable, on the surface, the situation in silver is far more fragile. Silver markets are smaller, less liquid, and more susceptible to supply shocks. So when I compare gold and silver, I see gold as a strategic monetary asset and silver as a hybrid asset that carries both monetary and industrial characteristics, making it more volatile and potentially more explosive in a supply squeeze scenario. What makes this situation even more compelling is the broader macroeconomic context, particularly the shift in central bank behavior. Across Asia and the global south, central banks have been steadily increasing their gold reserves, signaling a long-term move away from reliance on fiat currencies. This trend is not new, but it has accelerated in recent years due to geopolitical tensions and concerns about currency stability. In contrast, Western central banks have been relatively slower to adjust, which highlights a growing divergence in monetary strategy. As an analyst, I interpret this divergence as a fundamental shift in the global financial order, where gold is gradually being remonetized in the East while remaining underappreciated in the West. And when I compare these developments with historical patterns, it becomes clear that such divergences often lead to significant market realignments over time. Moving deeper into the physical market dynamics, the strength of demand coming out of China cannot be overstated. Even after a substantial correction from January highs, demand has remained resilient, which challenges the conventional assumption that lower prices are driven by weakening interest. In reality, what we are seeing is a market where physical buyers are largely insensitive to short-term price movements because their motivation is rooted in wealth preservation rather than speculation. The introduction of rationing mechanisms by banks, and even lottery-style systems to allocate gold, is a powerful signal that supply constraints are real and not just theoretical. From my standpoint, this is one of the clearest indicators of a tightening market, because when access to physical gold becomes restricted, it reflects underlying stress that is not visible in paper markets. Japan adds another layer to this narrative with its high savings rate and limited domestic investment opportunities. When households are saving a significant portion of their income but are not finding attractive returns in traditional assets like real estate or equities, that capital must go somewhere. The growing use of gold accumulation accounts provides a channel for this capital to flow into precious metals, creating a steady and persistent source of demand. In my analysis, this is particularly important because it represents long-term capital rather than speculative flows. When I compare this with Western markets, where investment behavior is often driven by short-term performance metrics, the contrast becomes even more pronounced. This reinforces my broader thesis that the center of gravity in the gold market is gradually shifting, where cultural and economic factors support sustained demand. At the same time, we cannot ignore the structural question of whether there is enough gold to satisfy global demand if confidence in fiat currencies begins to erode. The reality is that gold's supply is limited, and not all of it is readily available for purchase. Much of it is held in reserves or long-term storage, effectively removing it from circulation. This creates a scenario where even a modest reallocation of global capital into gold could overwhelm the available supply. While some analysts argue that gold introduces risk into a portfolio due to price fluctuations, I would argue that the greater risk lies in not holding gold in an environment where monetary stability is increasingly uncertain. This is where my view slightly diverges from more traditional perspectives, as I see gold not just as a hedge, but as a form of financial insurance against systemic risk. Now, if we bring all of these elements together, the picture that emerges is one of a market that is tightening beneath the surface while appearing relatively stable on the outside. The recent correction following January highs did not lead to a collapse in demand, nor did it flush out significant speculative excess, which suggests that the underlying drivers of the market remain intact. Short-term volatility, driven by factors such as currency strength or geopolitical developments, may continue to create noise, but these are secondary to the structural forces at play. When I compare short-term price movements with long-term trends, it becomes clear that the market is being shaped by capital flows, central bank behavior, and cultural demand patterns rather than speculative trading. Looking ahead, the key question is not whether gold will move higher, but how quickly and how violently that move could occur once institutional capital begins to align with its own forecasts. If portfolio managers start reallocating into gold in a meaningful way, the resulting demand could collide with an already constrained supply, leading to a rapid repricing. This is where the role of futures markets may come under pressure, as physical constraints begin to dominate price discovery. In my view, this could mark a turning point where the market transitions from a paper-driven system to one that is increasingly influenced by physical fundamentals. And when that shift happens, the implications for both gold and silver could be profound, potentially reshaping the entire precious metals landscape in ways that most investors are not yet prepared for.